Welcome back to Smart Stock Sam, where we cut through the noise and give you the data that actually matters. Today, we are doing a full reality check on BYND, ticker symbol BYND. Should you buy BYND before earnings hit tomorrow? And the honest answer is, it depends entirely on which side of a very dangerous coin flip you land on. Here is what we are covering today: the catastrophic capital destruction that brought this stock to its knees, the bizarre tug-of-war happening between Wall Street giants right now, the brutal technical picture that has traders on edge, the company's desperate strategic pivot away from everything that made it famous, an explosive legal and earnings timeline that kicks off today, a short squeeze setup that could send this stock screaming higher almost overnight, and the two specific numbers you absolutely need to watch on tomorrow's earnings call. This is not a story about a company slowly fading away. This is a binary moment, a make-or-break event where the outcome is going to be extreme in one direction or the other. So let us get into it. To understand why this stock is so dangerous and so potentially explosive, you need to understand the three specific forces that are ripping it apart right now. Force number one: pure financial distress. We are talking about a 78% decline in a single year, a delisting warning sitting on the table from the Nasdaq, a balance sheet that is, by every traditional metric, hemorrhaging. Force number two: a desperate strategic pivot. BYND is not just selling plant-based burgers anymore. They are literally rebranding, chasing what they are calling active nutrition, and even launching functional beverages. That is a massive identity shift for a company that once promised to replace the entire fresh meat industry. And force number three: catalysts stacking up like a car crash in slow motion, a delayed annual report, a securities fraud lawsuit, and a high-stakes earnings call tomorrow that could either save this company or accelerate its collapse. Most retail investors look at this chaos and either run away or blindly buy the dip. Today, we are going to do neither. We are going to read the data and understand exactly what is happening. Let us start with the chart, and brace yourself, because this is not pretty. From its 5-year high, BYND has lost 99.45% of its value. Not a correction, not a bear market dip, a near total wipeout. The stock ran all the way up to nearly $8 at its peak. Today, it is sitting at 72 cents. 72 cents. And here is what makes the current price so terrifying. That 72-cent level is hovering dangerously close to the 52-week low of 50 cents. That is the floor. If that floor cracks, and there is absolutely nothing in the historical chart underneath it, this becomes a true falling knife with zero support. The buyers who thought they were getting a deal at $2 got wiped out. The buyers who thought they were getting a deal at $1.50 got wiped out. At some point, the buy the dip mentality stops working, and all that is left is a company fighting for its life. Which brings us to the strangest part of this entire story. While everyday retail investors are panic selling or staying far away, the world's largest institutional players are doing something completely unexpected, and they cannot agree on what to do. On one side of the trade, you have Jane Street Group, one of the most sophisticated market-making operations on the planet. They have dumped 85% of their position in BYND. They are not trimming, they are running. But on the other side, Vanguard, the passive index behemoth that manages trillions of dollars, has actually increased their holdings by 477%. Now, the honest read on that Vanguard move is that this is likely index rebalancing or passive fund mechanics, not a bullish conviction bet. But the sheer scale of absorption matters. Total institutional ownership is down 22% overall, which tells you the smart money is broadly exiting. Yet the fact that any major institution is buying at these levels means the float is not in complete freefall. This creates a deeply volatile, thinly traded setup that is primed for extreme moves in either direction. And that brings us to the technicals. I am not going to sugarcoat this. The technicals are brutal. The stock is trapped below its 200-day moving average of $1.61. That moving average is not just a number, it is the line that separates a stock in recovery from a stock in structural decline. BYND is nowhere near it. The directional momentum indicator, the ADX, is sitting at 25, confirming that the downtrend is not just noise. It is well established and sustained. The combined fundamental and technical rating, 1 out of 10. The absolute floor, poor profitability, a balance sheet bleeding cash, and a business model that by the numbers has not yet found solid ground. The only question the chart cannot answer is whether tomorrow's earnings create a shock big enough to break the trend. And for that, we have to look at what the company is actually doing operationally. Let us be honest about what this strategic pivot really means. Beyond Meat is walking away from the very aisle that made them famous. The fresh meat counter, where the original Beyond Burger lived alongside real beef and chicken, is being abandoned. High spoilage costs, weakening consumer demand, brutal competition. They are retreating to the frozen aisle where shelf life is longer and margins are better. They are launching drinks. They are chasing active nutrition. Is this a smart adaptation? Maybe. But let us call it what it is: damage control. The original dream, that Beyond Meat would sit next to a T-bone steak in every grocery store in America and take meaningful market share from the beef industry, that dream is officially over. What replaces it might work, but it has not worked yet. And the company is attempting this massive identity transformation while staring down one of the most dangerous weeks in its entire corporate history. Mark these dates because the timeline right now is extraordinary. Today, March 24th, is the lead plaintiff deadline for a securities fraud class action lawsuit. Shareholders are alleging the company made misleading statements about the true value of their assets. That is not a routine legal matter. That is an allegation that management misled the very people who trusted them with their money. Tomorrow, March 25th, Beyond Meat releases Q4 earnings. This is the single biggest near-term catalyst for the stock. Everything pivots on what comes out of that report, and then there is the longer fuse, August 31st. That is the Nasdaq deadline. If BYND cannot sustain a closing price above $1 before that date, they are forced into a reverse stock split just to stay listed on the exchange. And in the markets, a reverse split is rarely a sign of health. It is a survival maneuver. 3 dates, 3 potential detonators, all inside a 5-month window. So what are we actually expecting from tomorrow's numbers? Preliminary guidance is pointing to approximately $61 million in revenue, a 20% decline year over year. Falling sales alone would be bad enough. But the thing that is genuinely alarming here is the reporting delay itself. The annual report is late because of what auditors call material weaknesses in internal financial controls. In plain English, the company's own accountants are raising flags about whether the numbers can be fully trusted. That is not a minor footnote. If management cannot demonstrate tomorrow that those weaknesses are being corrected and that the revenue decline is bottoming out, investor trust could collapse entirely. But here is where it gets truly interesting. And this is the part most people completely miss. Could this stock realistically double in a single day? Based on the short interest data, yes, it genuinely could. Nearly 35% of the entire float is sold short right now. Think about what that means. For every 100 shares that exist, 35 of them have been borrowed and sold by traders betting the stock goes lower. The days to cover ratio is 5.91, meaning if a squeeze starts, it would take nearly 6 full days of average trading volume for short sellers just to buy back enough shares to close their positions. And the borrow fee, the cost to maintain a short position in BYND right now, is sitting at 31% annually. That is not just expensive, that is punishing. So here is the scenario. If tomorrow's earnings come in even marginally better than the catastrophic expectations the market has already priced in, short sellers will be forced to cover. That forced buying creates a feedback loop of upward price pressure. In a stock this thinly traded with this much short interest, that loop can become almost vertical in minutes. This is the wild card. And the options market is already pricing it in. The options chain for this Friday is sending a very clear message. The market has absolutely no idea what is about to happen, but it knows it will be big. There is a massive call wall sitting at the $1 strike. Over 31,000 contracts piled up right there, acting as a magnetic ceiling for any rally. On the downside, put support clusters at 50 cents, perfectly aligned with that 52-week low. The implied move priced in by the options market, 32% in either direction by end of week. Traders are collectively saying this stock is either going back to $1 or it is heading to 40 cents. There is genuinely no middle ground scenario being priced here. And here is the cruel irony at the heart of this trade. Even if everything goes right tomorrow, even if earnings surprise to the upside and the short squeeze ignites, the stock runs straight into a hard ceiling, $1. That is not just a round number, it is the Nasdaq's survival threshold, and that creates a devastating dynamic. Any meaningful rally toward $1 is going to face aggressive selling pressure from traders who expect a reverse stock split and want to exit before the dilution hits. A glass ceiling built directly into the company's own existential timeline. So let us lay out the map clearly. In the bearish case, the stock hits 40 to 50 cents. This happens if tomorrow's earnings confirm that revenue is cratering faster than expected and that the material weaknesses in financial reporting are worse than disclosed. In this scenario, the 50-cent floor shatters and there is no historical chart support underneath it. In the recovery case, the target is $1. This requires management to demonstrate a credible, data-backed path to EBITDA-positive operations and show that the pivot to frozen food and beverages is actually gaining real traction. That is a 40% gain from current levels, but it runs directly into the delisting ceiling, a literal coin flip between collapse and a short-term bounce. For anyone brave enough to engage this trade, here is the framework. Entry level at 72 cents. Take profit target at $1, anchored to that massive call wall. Hard stop at 50 cents. If that level fails, the consolidation is over and the bottom truly drops out. One critical warning before you touch the options chain: implied volatility crush. The options market is pricing in enormous uncertainty right now. If the stock moves in your direction, but not dramatically enough, the options premium will collapse after earnings are released, even if you called the direction correctly. This is not a simple trade. It is a high-skill, high-risk, high-reward setup that demands respect. When the CEO starts speaking tomorrow, ignore the PR fluff and focus on 2 data points only. Number 1, gross margin recovery. Is moving to the frozen aisle actually reducing spoilage costs and improving unit economics? If margins are still deteriorating, the pivot is failing. Full stop. Number 2, 2026 revenue guidance. Is the Beyond Immerse functional beverage line generating real, measurable demand? If management cannot show hard, forward-looking data that the top line is stabilizing, the technical breakdown below 70 cents will not just continue, it will accelerate. Before we get to the final verdict, here is the disclaimer you need to hear. Nothing in this video is financial advice. Smart stock. SAM is an educational channel. Every trade carries risk, and speculative positions in distressed stocks like BYND carry extreme risk. Always do your own research, understand your personal risk tolerance, and never invest more than you can afford to lose. If you are unsure about any of this, consult a licensed financial professional before making any decisions whatsoever. Now, the final verdict. Beyond Meat is a textbook asymmetric risk. On one side of the scale, accounting red flags, a delisting countdown, revenue contraction, and a company that has lost 99% of its value in 5 years. On the other side, one of the most compressed short squeeze setups in the entire market, a 32% implied options move, and a technical gap of over 100% to the average analyst price target of $1.61. This is not an investment. This is a calculated, high-stakes, speculative bet on whether management can manufacture a credible reset story in the next 24 hours. Whether you are a bull or a bear, Tomorrow's earnings call will almost certainly define the future of this brand forever. Watch those two numbers, respect the 50-cent floor, and understand that glass ceiling at $1 before you put a single dollar at risk. That is the data. That is the reality check. I am Smart Stock Sam. Invest carefully, and I will see you in the next one.